Welcome back, Contemporary Math. We are in section 4C. The section is about savings plans and investments. Okay, so we're going to start off talking about the savings plan formula. So savings plans differ from the previous thing that we're talking about, compounded interest, and that now we are making payments or deposit small amounts over time, is what this says. So that's how these differ. So savings plans, we're going to start making regular sort of payments, monthly payments probably into something. So like an IRA, a 401k, or 529 plans for education. These are all sorts of things that people, or they're common savings plans that people use. So start off with a sort of simple example, but if we consider depositing $100 regularly every month into an account with an APR 1% in 6 months. Ooh, that's right, it was 12%. Sorry, that should be 12%. I just realized the monthly APR divided by 12%. So the APR should be 12%. So this is my monthly. Okay, so if we're starting this, I try to make those numbers easy so that it's not hard to calculate. If we consider starting off with $100, so there's a sort of weird thing that we do when we do savings plans. We're going to start the first month off, and we're going to start it with $0. So we don't actually start calculating things till the end of the month. So at the end of the first month, that's when you're going to make your first deposit of $100. You're going to make your first payment. So you're going to deposit $100. Think about what's happening at the end of the second. So at the end of the second, I'm going to deposit another $100. I'm going to have $1 in interest. And then I'm going to have that $100 I just deposited. And so this thing is going to get probably progressively harder to figure out this way. But my total is now 201. I have a 201 balance. I have an interest of this thing, $2. $100 deposit. This is going to give me what? 303. So you probably figured out I don't want to do this because this is only going for 6 months, and it's already getting really complicated, convoluted, a lot of nasty stuff. So we want a sort of formula to get at this thing. And so if I look at each individual payment, like this $100 deposit, so I'm depositing this $100 at the end of the first month. I can kind of trace this deposit, and so I'm depositing $100. It's getting the 101% treatment, just like kind of when we're doing compound interest. So you might notice this formula looks kind of familiar. It looks kind of sort of like the thing we were doing when we're doing compound interest. So if I think about this, I have $100 and it's getting the 101% treatment. It's getting it 5 times because the first month it doesn't get it, but the next 5 subsequent months it gets it. So it's 5 and not 6 because we do the end of the month payment set thing. And so it's not actually getting the interest with the first month. So you're starting out with $0. So it's like a bit of a weird thing, but that's why this is 5. And if we think about the end of the second month payment, it's going to get the 101 treatment 4 times and so on. And so the last thing that you do is you deposit $100. That $100 is not going to earn any interest. That lasts the 6 months. When you deposit $100, that's all you're going to deposit. If we want the total of this thing, we can add these things together. So if I'm looking at this example, so this is my example that I'm giving here with $100 depositing for 6 months. It's going to give me this amount. So how am I getting this? I'm generalizing this thing a little bit. If I have a period of what, 6 months, I'm doing 1 minus that. I'm doing 1 plus the interest rate, and I'm doing a payment here. So if I want to generalize it, it should look like this. So I could go and generalize it for in months now. So there might be more terms in the middle here. That's why there's the ellipses. But if I want to get the accumulated amount, what I'm doing is I'm adding each one of these things. So I'm starting off with a single payment. I'm working my way up until this term. And I'm going to say it like this is really complicated and convoluted, and it is a bunch of math. I'm not expecting you to know like these processes, right? I'm using this to get at something better. And so this is from the previous page, this accumulated amount that we're looking at here. So this, I don't know how to say it, but like this comes from people staring at these things for years and years on end. I'm not expecting you to know this stuff, definitely not overnight. So they decided I want to multiply everything by 1 plus I. Not something that's really readily like apparent that you should do, but they take this thing, they multiply this by 1 plus I on the left. You have to multiply each one of these things by 1 plus I. So this becomes a payment times 1 plus I. This becomes a payment times 1 plus I to the second. So I don't have that in here, but it's in the ellipses here, right? There's ellipses here that indicate there are multiple terms here. We don't know how many, so we use a general sort of term called n. So I'm multiplying everything by 1 plus I. If I multiply this by 1 plus I, it's a weird exponent sort of thing. But if I'm multiplying, I'm adding 1 to this. So now instead of n minus 1, this is going to become n. Instead of n plus 2, this will become the n minus 1. So if I multiply everything by 1 plus I, I'm going to change this series a little bit. So when we sum things and we sum a sequence, we call that a series in math. So this is just a mathematical series. If I multiply everything by 1 plus I, and then I subtract a from this thing. So this left side is going to be a times 1 plus I, and then I subtract an a. And then this side, if I write this out, a lot of these middle terms will simplify out when I subtract them. So this is the same term. Anything written in these ellipses is going to be the same term. So I don't know how many there are, but I know they will simplify out. I know each one of these things will match with something here. So this will match here, this will match here, this will match here. So what I'm actually left with is this thing right here. And I'm subtracting this thing. So I'm got payment times 1 plus I to the n, and I'm subtracting a single parent. So this left side, I can distribute this. This is a plus ai minus a. If I distribute that and then I subtract an a, I'm left with just an ai. If I factor out a payment from both of these things, I'm left with this thing, 1 plus I to the n, and then I have to subtract 1. If I want just the accumulated amount, I have to divide by I. So I divide by I, and I end up with this thing. So this thing, there is one thing. So n is the number of compounding periods. So that was something that we would say previously was ny. So capital N would be like our lowercase ny that we had before. My I is my APR over n. Those are the things I was kind of assuming in there. But if I assume that, then we have this equation, which is our savings plan formula. So this is assuming we're making regular payments, which means each of our payment is the same amount. So if you do payments that are different amounts, you have to figure that out differently. Okay. So let's look at this thing. I know it was a bunch of math, but here we go. A equals my payment is the new thing that we're introducing here, right? So A is still the accumulated amount. That's the amount at the end. PMT is my payment. This thing, 1 plus APR over N to the NY, should look familiar. So we have to do this thing, and we have to do all these operations, and then we have to subtract 1 from it at the end. And then after we subtract 1, we're dividing by APR over N. So all these things should look somewhat familiar. Hopefully, APR is my annual percentage rate. And they're going to give it as a percentage. I have to convert it to decimal. N is the number of payment periods per year. And Y is the number of years. Okay, so that's a bunch of symbols. Let's try to add a little context to it with a few problems. So example 1, use the savings plan formula to calculate the balance after 9 months for an APR of 15% and a monthly payment of $150. So this, if you have to, it's the savings plan. So we want to use this savings plan formula. Calculate the balance, so we want to know the accumulated amount. And they start giving us information. The payment is the first thing we want to pull out of there. The payment is I'm multiplying this by big fraction that says 1 plus APR divided by N. 1 plus APR is 0.15. I want to divide that by N. So monthly payments here, so N is 12. This is to the Y, which is 9 months. Oh, man. Okay. So N times Y, 9 months. Oh, that's kind of an odd thing, but it's going to be 0.75 or 3/4 of a year. Subtract 1 to not put my parentheses in a good place. And all this is over the APR over N. 5 over 12. And just to recap, I'm doing 9/12 is 0.75 of a year. I'm doing that conversion. So it's kind of a weird thing. Sorry, it's 9 months. Should be like an even number of years. But I think the book does that. So I was trying to throw it out you because they might do that, right? 0.15 divided by 12 is 0.0125. I can clean this up a little bit. You have to do your order of operations correctly. First thing, I can divide this and add this. This is all in a set of parentheses, so I'm going to do that in one sort of swoop. 1.0125. And I'm raising this to the 12 times 0.75 or 3/4. There are going to be a total of 9 compounding periods. You're doing this for a total of 9 months. And then I have to subtract 1 from whatever this is. And I have to divide this by 0.0125 is that fraction down there. What I'm getting is like something like 1.11829. And I'm going to subtract 1. So I'm raising this to the 9th and subtracting 1. It should give me a 0 out in front, and it should give me something like 11829 on top. And I'm going to divide that 0.0125 on bottom. So I'm getting something like 150 times 9.46, somewhere in that ballpark. So I'm not rounding these things. So if you're getting a little off, that might be why. But as long as you're in the ballpark and showing your steps correctly and doing appropriate math, I think you should be okay. And what, 51 cents if I rounded it. Okay, step back and see what this means. So you're doing a savings plan formula for 9 months. You're going to deposit 150 9 times. So if you think about it, you're depositing $13.50. If they ask that question, we could figure that out. But you're going to deposit $13.50, and what you're actually going to accumulate or realize is what they like to say, right? We're going to realize $14.19.51. So we're going to realize, I don't know, 19. What is that? $69.51 extra. So you'll actually get a little bit extra, and you'll get a little bit extra because you have what, 15% interest. So that's a pretty high interest rate, if I'm being honest, for an account. I don't believe savings plans are usually that high, but I could be wrong. Okay, so that is the first example. Even throwing some fractions in there. So you decide to regularly deposit $20 at the end of the month in an IRA with an APR of 6%. How much we have saved in 40 years? So now we have a smaller percentage rate, but we have a lot more years. We're doing this for 40 years versus like 9 months. So let's see how much we will get off of this thing. So my accumulated amount is equal to my payment. That's the payment of $20 that we want to make. Now I'm doing this thing. It looks like 1 plus APR. 1 plus my APR is 0.06. I want to do this each month. And I want to do this to the end, which is 12 times Y, which is 40 years. And then after I do all that, I want to subtract 1. And I want to divide this all by my APR over N, which looks like 0.06 over 12. So you might notice there are some things in this formula that repeat themselves. You can use that to your advantage a little bit to pick out those numbers. APR over N should be APR over N, whether it's on top or bottom. The N is the same thing here. The Y should be the number of years. So that's something you have to pick out. Okay. Okay, same thing. We got our formula. Hopefully you know what each of those variables in the formula means. And once you do that, you plug in everything you know, and you should have something like this. So once you have something like this, then there's a little bit of order operations we got to do. But if we divide 0.06 by 12, that gives me 0.005. And if I add 1 to it, it's going to give me 1.005. So this looks like 1.005 is what this thing looks like. I'm to the 12 times 40, which is 480. So I'm raised $8. This is 0.005 on the bottom. So 1.005, I raise that to the 480, and I subtract 1. And I'm going to round this. I'm probably not going to round it when I do the calculation. So if you're a little bit off, it's probably a rounding error. So 9.957. I'm getting somewhere in that ballpark. And this is 0.005. So I have to take the 9.957, divide it by 0.005, and then multiply it by 20. So it's going to be 1991 by 20. So this should be giving me, 39 29 is the number I'm getting here. Ooh, and asked an extra little question in my notes. So if we get 39, 829, 81. By doing 20 by 1991.49. Somewhere in that ballpark is what you should get. I think with this rounding, it's going to give you 80. You're going to be 1 penny off of that instead. So we did all this work. So if this is a problem that you get, fill in your information to the formula. You figure this out. So this is what you get 40 years. You get around 40K. And to recap, you're making 480 payments of that. So I think you're making 480 payments of 20. You're going to make it around 9,600 in payments. You're going to get around 40K in total from your savings. Okay, so this is what happens if you deposit $20. So my next question, real quick, what happens if you deposit 30? So if you deposit 30, what's going to change here is kind of the question that I'm asking. So if we go back and look at this, and if you have to look at your formula, what am I changing here? The only thing I'm changing is this payment out in front. So if you want to do this and you got problems like this where they might change the payment that you're making or ask about the payment, if it's a different amount, we've done all that hard work. We don't have to do it again. So if you do this a little bit smarter, you might save yourself a little bit of time. 291.49. This gives you what? 59,744, 72 cents. 70 cents if you round it. Okay. All right, so one more. What does it say? Congratulations, you're pregnant. You're having a baby. Okay, so you want to save 150K for your child, their future education. So they're going to start attending college in 18 years. You found an account with 3% interest. How much we have to deposit monthly? And so you might notice if we use or start looking at this formula, this is going to solve for accumulated amount. And so they know the accumulated amount here. What we want to solve for is payment. And so this is payment times some junk. If we wanted to solve for payment symbolically, if this is being multiplied, one way you could do it is by dividing by this thing. But dividing by this thing is the same thing as multiplying by a reciprocal. So if we flip this thing, 1 plus APR over N, I can write it off, NY minus 1, put this all under 1 bar. If we do that to the left side, we have, or to the right side, we also have to do it to the left side. So APR over N, 1 plus APR over N. So now I'm writing sloppy, but you can see what the symbols are in that formula. We got to do that to both sides. And if we do that to both sides, this should be simplifying this thing out. This thing is now attached to an A. So if you look, and you don't need to look at that, but if you look at this thing, it looks like this previous formula. But the one difference, or the one sort of swap that's made, we're flipping things. So let me this side by side. So we're just flipping that sort of crazy fraction thing that's there to put it on the other side. So it's like we're dividing by a fraction or we're multiplying by its reciprocal or the same thing. So it is the same formula, just being flipped to solve for the other variable. Okay, okay. So if you want to go plug it into that first formula, you can, but we have a formula to solve straight for the payment. So let's use it at the bottom of your page. Payment equals the accumulated amount. So the accumulated amount we want here is the 150K. So 150K, and we're going to multiply this by my APR over N, which is the 0.03 over N, which is the number of compounding periods, which is, here it's not compounding periods, it's the number of payment periods, I believe. It's the same thing, right? Yeah. So that maybe I should make that distinction. It is the number of payment periods here, but it's the same thing as the compounding. So this is 12 monthly sort of compounding or monthly deposits, 0.03 over 12. On the bottom, it's 1 plus that thing. 10 times y, which is 12 times 18 years. And I have to subtract 1. So now a thing that was in the numerator is going to be in the denominator. Thing in the denominator is now in the numerator. So again, some things repeat. So if you have that fact, use that fact to your advantage. So this looks like 150K. 0.03 over 12 is 0.0025. So this is 1.0025 to the 12 times 18, which is 216. And I have to subtract 1. So I don't know exactly where people go awry on this thing, but a lot of times people will see this thing as it is an exponent. It is supposed to be an exponent, so you're supposed to raise this to this power. So this is 1.0025 raised to the 216th power. Sometimes people start like multiplying things or doing something weird. But these are exponents, so you have to plug them in as exponents. You have to do the operation as an exponent. We're raising that to the 216 and then subtracting 1. I'm going to do this all in one step. So I'll get 1.714. I subtract 1. It should be somewhere around 0.714. Something in that ballpark. So I'm doing 0.0025. I'm dividing by 0.7148. That's probably need to round that a little bit more, probably. Okay, so I have 150K. And now multiplying this, I have a number 0.003497, somewhere in that ballpark. 7. And it should be around 520, 554.58. think if you do the rounding, you'll be around 3 cents off on that one. Okay. So with this said, I am not expecting you to memorize these formulas, right? If I give you a formula like this, these formulas should be on your test, right? I'm not expecting you to memorize this stuff. But it will be probably something just like this. You have to know this, the symbols, you have to know the letters in that formula, right? And you have to plug things in and do the correct math appropriately. You have to raise these exponents. You have to know order of operations and what order to do these things in, right? Got to do things in parentheses. Got to do this exponent before I do the subtraction. Okay, so just step back again and recap this one. If we want to accumulate 150K for your child's education and you have 18 years and you want to make regular deposits, how much would you have to deposit monthly at a 3% interest? You'd have to deposit $500 a month. So. Okay, so now we're doing another savings plan. We look at this, it says you would like to retire 30 years from now and have a retirement fund from which you can draw an income of 50K per year forever. How would this be possible? Assume APR is 5%. So this is a bit of a weird problem or a weird setup. So they want to know how it would be possible to have an income of 50K per year. And they want to know how it would be possible if we have just a sort of retirement fund set up. How would you be able to draw 50K per year and just keep drawing 50K per year from it? Well, what they're trying to tell you is that this 500,000 or 50,000, sorry, I can't speak anymore. If that 50,000 is just from your interest. And so if this is from interest, what happens is we have this principal sort of balance on this thing. We can draw this 50K from our interest each year. We can leave that principal untouched. And then we just have the 50K that we can draw from it. So what this is happening is this 50K is straight just from interest. And so this is our earnings from our interest. We can leave the principal untouched, and each year we just keep getting 50K just from having a buttload of money in an account, basically. Pretty sure this is principal. Am I allowed to say that still? I should know how to spell that. Okay, so if we're going to get this 50K from interest and our interest is 5%, each year we want to get this 50K. So if our interest rate is 5%, this is telling me 5% of some amount that's in my account is going to give me that 50K. So how much do I have to have in my account to have just that 50K, just skimming off the interest of that 50K each year? So in order to find the amount that you need in your account, it should be 5123 divided by 0.05. We're dividing both sides by 0.05. So this amount, the desired amount in my account to get this balance is going to be, is that 36? That is $1 million. Count the zeros in there. There are 6 zeros in there. This is $1 million. So if we have $1 million in our account, we can just draw 50K, and 50K is a pretty livable amount per year. It's living pretty comfortably. So if you just have $1 million, you can basically just have an income if you find an APR of 5%. So this is the desired amount we want in our account. So now we want a savings plan formula to save this amount. So what is the sort of payment we would need if we wanted to save $1 million? Was what our question is becoming now, right? If I want to rephrase it. So what payment would I need? So I want to go to my payment one for $1 million. And now I'm multiplying this by that crazy fraction thing. So I know my interest rate on my savings plan is 0.4. I know I'm doing it monthly. It is 1 plus 0.05 by 12 to the n times the y to the 12 times. And the amount of time they gave us to save this was 30 years for our retirement. And I'm going to subtract 1. So this is coming from the savings plan formula, defined payment. So what is the payment I would need for $1 million with the 5% interest, done monthly, done for 30 years? This is the information I'm plugging in here. So I have it set up. So I'm going to probably go a little bit quicker with each example, maybe. That is the same. Try to go 0.05 divided by 12. Gives me somewhere in the ballpark of 0.004167, but I round it. It's a 6 repeating. It gives me 1.004167, and I have to raise this to the 12 by 30, which gives me 360. And then I have to subtract 1. Okay, so 12 plus 1, and I'm going to raise that to the 360. Subtract 1. On the bottom, I should be getting something like 3.4677. When I do 0.004167 over that point, and then multiply that by 1 million. 1, 2, 3, 4, 5, 6. Woo. So I have to divide these and multiply by 1 million. This should be giving me somewhere in the ballpark of 1201. And I'm going to round that 54 up to 55. And so what is this telling us? If we want to accumulate $1 million and just live off of money for the rest of our life that we earned, we have to deposit $1,201.55 into an account monthly for 30 years is what we're doing. Okay. So this is a savings plan. That's the savings plan formula to find payment. We can use it to find accumulated amount, or we can use it to find payment. So there are two formulas that are really the same formula. So now I want to talk about total annual return. So your account grows from 1,000 to 4,000 over 3 years. So the first thing is the total return. So total return is exactly sort of like you might expect. If I want to know my total return on this, it is the relative difference of the two amounts. So if I'm looking at it going from 1,000 to 4,000, 4,000 minus 1,000 gives me their difference. And then if I want relative difference, I have to divide this by 1,000. And so what this is giving me is 3,000 over 1,000, or just 3. And so if I want to convert that, that is telling me it is increasing 300% is what this is telling me. And so when we talk about total return, we're talking about a percentage. So I think I might have dropped it, but this I have to multiply and convert to percent. Total return, we've done this before. It is the relative difference of the two things, or the relative increase. The annual return. So total return, you might notice I don't care about the number of years. I'm just doing the relative difference of the two. Annual return, I want to know if this thing was figured out annually, what would my return be? So I'm thinking this sort of like this thing is compounded, it's some sort of principal, and then I'm multiplying by my 1 plus whatever my annual percentage return would be to the y. So what I want to figure out is what my annual percentage return is going to be. And so if I solve this equation for my APY, there's a few things I'm going to do right quick, but I'm looking at my APY, it's being added and raised to an exponent here. And so I'm working this thing backwards. The furthest thing away looks like this multiplied by P. So the first thing I would have to do if I wanted to solve for my APY is divide both sides by P. So if I do that, I end up with 1 plus APY to the y on this side. And so this is like 1 plus APY squared is equal to something, and we wanted to solve for this thing by itself. I think some people might realize we're taking a square root, we're doing something like that. This thing square roots I can think of as fractional powers. So another way you can think about this is I'm raising this all to the 1 over y, and we didn't go over fractional powers, but if I have, or we didn't go over exponents in this, but if I raise exponents to exponents, what I'm doing is multiplying this. So y times 1 over y is going to give me a 1 in the exponent here. And if I do it to that side, I also have to do it to that side. So there's a 1 over y exponent happening here, is what is happening. That's why I'm pretty quick. This is 1 over y. 1 plus whatever my annual percentage return is going to be. And so there's one other thing I have to do to solve for my annual percentage return, and that's subtract 1 from whatever solution. And so that this formula is the thing that is on the next page, I believe. So consider an investment that grows from original principal P to a later accumulated amount A. The total return is the relative difference of those things. So I'm taking my accumulated amount and subtracting it from my original. This is the new minus old over old, is the same thing that we did in the previous chapters. And then I convert that to a percentage. So this is your total return. Your annual return is going to be the accumulated amount divided by the principal. I'm going to have to raise that to the 1 over y power. So that's going to be a weird thing. And then I have to subtract 1. And so that's sort of like assuming it was compounded once per year. Like, what would the interest rate be, right? It's sort of like asking that question. What is my annual return? What is the percentage return that's happening each year? So it is a sort of average what we're usually doing. It is not exact, right? And it's going to change if we change how many years we've done this. So this is contingent upon how many years you're doing this, right? And this gives you an annual return in a decimal. We're going to have to convert that to a percentage. So we do convert this to a percentage, and it doesn't tell us in the formula. So that might be something you have to kind of take mental note of. Just following the book's guide on that one. Okay, so we have another example to tune into. I didn't do that previous example. So if we go from 1,000 to 4,000 over 3 years, My API is this thing. A over P, 1 over Y. My amount is what? 4,000 over 3,000 over Y to the 1 over 3. And then I have to subtract 1. So 4,000 over 1,000, I already know that's 4 to the 1/3 minus 1. So 4 to the 1/3 power. So you do know how to, you're going to have to know how to do fractional exponents somehow. So 1 divided by 3, you might have to put parentheses around this if you put it in your calculator. 4 to the 1/3 should give you something like 1.587, and we want to subtract 1. Let's go one more decimal place. 1.5874, we're going to subtract 1. This is 0.5874 or 58.75%. What happened is this went up by about 58.75% each year. I think I've rounded up the wrong way, huh? I guess it should be 7.4. I don't know why I rounded that up. Okay. So now we have another example of how to do these total returns and annual returns. So we invest 500 in mutual fund. It grows to 2,000 in 5 years. What is the total return? What is the annual return of this thing? Total return is 2,000 minus 500. So we've done this a few times. I don't want to spend too much time doing this one. But you should be able to take the relative difference of two things at this point. If not, come see me after class or something. I don't know what. These are different numbers, right? Okay. We should be getting 300% again, I believe. We're going to do 2,000 minus 500 is going to give me 1,500. Divide it by 500 is going to give me 3. And then multiply it by 100, it's going to give me 300%. The annual. If I want to do 2,000 is my accumulated amount over my principal, which is $500. I want to do that 1 over Y over the number of years is going to be 1/5. And then I want to subtract 1. So 2,000, and I'm dividing that by 500 is going to give me 4 to the 1/5. So 1/5, even if you want to do like a decimal, it might be easier to do a decimal power in your calculator, depending on what calculator you have. This is 4 to the 0.2. Gives me something like 1.3195. And then I have to subtract 1, that gives me 1.3195. What I'm saying is, I need to raise that up a little bit. Okay. This is somewhere around what, 31.95%. Okay. I think we have one more return problem, and then I think we start talking about investments and stocks and how to read stock tickers and all that good stuff. So this section, I will say, is a bit long. It is a long section. Excuse me. But excuse me. Okay, so it is a long section, but we will spend some time just on this one section. So I dedicated a whole class to this one. I usually dedicate a half. So hopefully we'll get through this fine. We should have plenty of time. So total return here, if I purchase stock for $1,000, 4 years, I'm going to sell it for 800. What is the total annual return? So here, I'm trying to get at a point here. I hope you notice it. When I do my total return, this is my relative difference of these things. So you do have to write these things in the right order to get it correct. This is my principal. This is my amount. My P, this is my A here. Might notice your amount went down from your principal. That is completely possible when you do things like stocks. Okay. So it might be possible that our total return is going to be a negative number is what we're going to get here. We're going to get minus 200 over 1,000. Convert that to percentage. It's going to give me a minus 0.2, which is 20%. You have to account for the negative being there. And the negative tells me that this thing is going down 20%. So going from 800 to 1,000, we're going down 20%. Sorry, going from 1,000 to 800. We said that backwards. The next thing is the annual return. So if we look at the annual return on this thing, look back at that formula for your annual return. I'm not expecting you to memorize formulas. I want my A over my P, my accumulated amount over my principal. So now we have 800 over 1,000. And I'm raising this to the 1 over y. So this is the 1 over. And how many years am I going on this thing? They went for 4 years. And then I have to subtract 1. So you might notice I'm getting a fractional amount in here. Previously, I got a whole amount. But if I do 800 over 1,000, that's giving me what, 0.8. So quarter is 0.25. So if I do 0.8 to the 0.25, it's giving me 0.9547. And this is giving me, if I subtract 1, you might notice this is going to be a negative number. So this is going to be somewhere around negative 0.543. And so that is my annual return. The other thing I have to do is convert this to a percentage. So I move it 2 decimal places, negative 5.43% is where I should be about. And this is my annual return. So what this is telling me is that each year it's going down by about 5.43%. So it's important to put the negative in there to indicate that this thing is going down. So I think the purpose of this problem is to make you realize that your total return and your annual return do not have to be positive numbers. You could lose money, it could be negative. And if you lose money, it should be negative. Okay, I had to restart my camera there. It was getting a little bit laggy. So types of investment. The book likes to talk about 3 basic types of investment. So the first they give is a stock, a bond, or a cash investment. Okay, so stock or equity. So stock or equity, what does a stock do? Stock that actually gives you ownership in something. So you actually own stocks of it. And you can look at the stock market, trade stocks, things of that nature. You trade shares of a stock. So you own a share. And what it literally means is you own a share of that company. So you invest by purchasing shares of the stock, and the only way to get money is to sell the stock. Well, that's not true. That's not the only way. They tell you on the next page. You also get dividends from stocks sometimes. Because stock prices change with time, the sale may give you either gain or loss on your original investment. So these things can go up, they can go down, you can lose money with stocks. So we started with savings plans. If you put money into a savings plan, you're obviously not going to start losing money that you put into a savings plan. So now we're talking about things that you can actually lose money in, like stocks. A bond, you're not going to lose money in, right? Unless if it's a government bond, unless your government just goes kaput, I guess that's a possibility. But there's a little more assurance with bonds, right? They represent a promise of future cash. So like this, you can, like they used to sell war bonds. They still do, but they used to be a big thing. So usually buy bonds either by a government or a corporation. The issuer pays you simple interest. So these are simple interest. They're not compound, and they will pay you back however much you loaned them plus a simple interest rate. And they have a date of maturity, right? So there is a date you have to cash them in, but there's an amount of time you have to wait. Cash investments include money you deposit in their bank accounts, certificates of deposit, CDs, and treasury bills. So they generally earn interest, but not always, I guess. Okay, so now we're going to talk a little bit about investing and the ways that people invest in these things. So there are two ways that people typically invest in things, and that's either they invest directly or through a broker. The other way, you can, and this is like specifying exactly what you want to invest in, right? The other way is that you do a mutual fund. And the way that a mutual fund works is that someone's managing that and they just throw it all and they invest in multiple sort of things. You're investing in multiple sort of things with multiple people. Okay, so what sort of considerations do they talk about in the book when you make an investment? So there are three sorts of considerations that they talk about. So one of them is, whoa, there we go. One of them is liquidity. So what does liquidity mean? So something that is liquid means it flows easily from one thing to another. So this is being able to get your money out of something. So this is being able to convert whatever you have into like straight cash, basically. How difficult is it to take out your money? Investment from which you can withdraw money easily, such as a bank account, is said to be liquid. So if you want to, you can go take your card, you can go get that money for it right now. So that is not the way it is with stocks, right? You have to get a broker to sell them and you have to find someone to buy them, right? And so those would be less liquid, right? And if you own physical assets, those would be less liquid than like a bank account, right? If I have something, physical assets, I have to sell them before I get any sort of money off them. Got to find a buyer. So this is how easy is it to convert to money. Risk is exactly, risk and return are exactly like you probably think they are, right? Risk is how much risk is there. So if we think about, like I said, a stock versus a bond, right? A stock could go up, it could go down. You are risking quite a bit, right? The safest is your investment principal at risk. So if it, in a stock, you can actually lose your principal and you can lose money in a stock, right? In a bond, you're probably not going to lose money. It's probably just going to mature. You probably get cash it out at the end. But the biggest difference between a stock and bond is you don't hear people raking in money with bonds, right? So there is a risk versus reward sort of thing happening, right? The riskier something is, typically the larger the reward, and vice versa. There's a sort of trade-off that usually happens. So the safest investments are usually federally insured accounts, U.S. Treasury bills. There's virtually no risk of losing principal you've invested unless maybe your government goes belly up or something. Stocks and bonds are much riskier. They can drop in value. In which case you may lose part of all or your principal. the return. So the return is the total amount. How much are you expecting to get off of this thing? A higher return means you earn more money, but it typically means it is a higher risk. In general, low risk investments offer relatively low returns, while high risk investments offer prospects of higher returns, along with the possibility of losing your principal. So one way that people talk about returns is by talking about this thing called the Dow Jones Industrial Average. And so the Dow Jones Industrial Average is, they take the average price of 30 large companies. And this is the thing that was chosen by the editors of the Wall Street Journal. I know I said it like previously. When we were talking about CPI, I referenced this. I couldn't remember what it was that the Wall Street Journal editors chose, but here it is, the Dow Jones Industrial Average. So the companies are chosen by the editors. I should specify that, right? The prices aren't chosen by the editors. That would be a little weird. But they take the average price of 30 large companies in the stock market, and they take the average of it. And so the Wall Street Journal editors choose the companies that they pick, and then they average them. Okay. Your great-great-grandmother invests $5 into each of the following types of accounts in 1990. Approximately how much would each be worth in 2012? And they give us the average annual return here. So if we have an annual return, this is the key that tells you probably what formula you should be using. So if I'm doing an annual return, that is the thing that looks like I'm 150 per. We don't have it in here. To the number of years. So I know my principal is the $5. I know my APR from this column that they're giving me it. So I'm going to have 3 different accounts I have to figure out. But what I don't know right off the top of my head, just looking at this problem, is Y or the number of years. So how do I figure out the number of years? I'm going from 1990 to 2012. I have to subtract those two. That should give me 112 years. What am I? Oh man, that's not right. I think I'm going to do 1900. Sorry. Would that make more sense? Yeah, okay. That's what I did in my notes. Sorry. So change this number. This will make more sense if it's your great-great-grandma, but she's living in the year 1900. I'm changing the problem a little bit, so take note. Did not put the right date in there at all. So, this is a long section. There might be a few typos in here. So let's put in 19. So I want to go for 112 years. They can tell you that in a multitude of ways within the problem. But we know our accumulated amount for, let's start with stocks. The first thing we want to do is stocks. I want to find my accumulated amount when my principal is $5. I want to do 1 plus my APR, which is 0.063, and I want to do that to the 112. So we have done a few problems like this. So 1.063 to the 112 is what I want to do first, and then I want to multiply that by 5. And so if you're doing this correctly and you want to round up, this should be 4684. and 85 cents. Bonds. So how is bonds going to change? Well, the 5 is still the same. The 1 is still the same. Right here is the 0.063 is going to be 0.02%. I have to raise this to the 112. Okay, so this should give me 45.94. And then the last thing we're doing is the cash. So if I want to know the accumulated money on my cash, it's 0.9%. So this is 5, this is 1 plus 0.009 to the 112. And if I'm doing that and rounding it up, it gives me 1364. Okay, so this is giving me 1364, 45.94, and what? 4,684. So the average annual return that you're getting is going to make a pretty drastic difference, especially when we go for something like 112 years, right? Okay. So we want to talk a little bit about stocks. So stocks, there are two sorts of things that we can have when we make money off of stocks. You can do a capital gain, or it could be a loss. That's if you buy and sell a stock. So if you sell a stock for more than you paid for it, you have a capital gain. If you sell it for less, then you have a loss. The other thing is a dividend. So a corporation distributes part of all of its profits to the stockholders. It's proportional to the number of shares that you hold. So when a company makes a profit, sometimes they distribute part of that profit to the stockholders. So sometimes you get money just for holding on to a stock. It's like you own part of the company, so you get a share in part of the profit. Proportion. Okay. So here is a stock ticker. This is what a stock ticker might look like. And so I think I have this thing pretty much in left to right order. If we see the stock symbol, the company name, and or the ticker symbols that they refer to it as, used to identify. What I'm talking about is this thing that says College Mathematics Corporation, CMCR. That's the stock ticker. The last is the price per share when you grab this ticker. So it is the price when you grab this thing. When we looked at it. It is at the time shown. The change is how much it's changed since the prior day's close. So if you want to know how much it was yesterday, this is the change from yesterday to today. Change percent is the same thing, but it's written as a percentage. The volume is the number of shares that have been traded today so far. The open is where it opened for the day. The highest was its highest point of the day. The lowest was its lowest point of the day. So we can do it for the day. We can do it for 52 weeks. We can do a high and a low for the 52 weeks. The other thing, we're going to the other side with the market cap. So market cap is the total stock value of the company equal to the total number of outstanding shares times the share price. So I'm jumping, but shares outstanding is the total number of shares that exist for that company. So if we want to know the market cap, it is this number, which is the number of shares times the price of each share, is going to give you the total price of all the shares, is what they're saying there with that market cap. price to earnings ratio. So this is if you take a share price and you divide it by the earnings. So this is given a little bit weird because it's given it as a ratio, but they're taking this price, dividing it by earnings, and getting this number. Okay, and the next thing is they have a dividend, which is the latest quarterly dividend, and so that's what it's paid during the latest quarter. And so that is like the money that you're earning from holding on to that stock. The next thing is the dividend yield. That's the annual yield of the dividend based on the current share prices and dividend per share. Ooh. And so I didn't say it, but this 0.34, this dividend for the latest quarter is the dividend per share. And dividend yield is using that dividend and the current price to give you a percentage. And then the shares outstanding, I already talked about it, but that's the total number of shares that that company has. So this is a lot of information, but we'll do an example or two probably to get at what this thing is telling me. So what is the symbol for CMCR? So this, I believe, is the same ticker from the previous page. But if I want to know the symbol for College Math Corporations, the ticker symbol is CMCR. So if I'm looking in the stocks and it's giving me a up or down change on CMCR, I know they're going to talk about College Math Corporation, and it's only talking about College Math Corporation. All right, that's the symbol that represents it. What was the price per share at the end of the day yesterday? So if it changed by going up 13.13, and now it is at 15.98, what was it yesterday? So in order to figure that out, we have to take the 15.98 and we have to subtract the 0.13 to go backwards to yesterday. We're on line. Minus 0.13. Based on the current price, what is the total value of the shares that have been traded so far? And so what they mean is so far today, right? What is the total value of the shares that have been traded so far today? So the volume of the shares is what we want to look at. There are 64 million shares that have been traded, and the value of each of them is $15.98. So what this is telling me is that I should take the value of each share times the total number of shares that have been traded. So if I do $15.98 and multiply that by 64 million, I should end up with 1,022,720,000. Somewhere in that ballpark. So there's been $1 billion, over $1 billion of money traded for the share today. There are 64 million total shares that were traded. Each of those shares cost $15.98. Okay, and part D says, what fraction of all College Mathematics Corporation shares have been traded so far today? So there are a few ways to do this, but I want to save a little space on my zeros. This says there are 64 million that were traded today. This says there are 5,554 million shares total. So if I want to know the fraction of shares that were traded a day, what I want to know is 64 out of the 5,554. If you want to write in 6 zeros to make these both millions, you can do that. But really, these are the two important numbers that I need to grab here. I'm doing 64 million over 5,554 million. And if I do that, I'm getting 0.011523. So what this is telling me is that this is around like 1.15%, more in that ballpark. So about 1%, right? Suppose that you own 100 shares of College Math Corporation based on the current price and dividend yield. What total dividend should you expect to receive this year? So if you have 100 shares, and we know the dividend yield is 8.51%. So we have 100 shares, and they each cost what, $15.98 per share. So our shares are worth $15.98 total. So this is the total amount of money or value that I have in that share. But if I want to know how much my dividend is, it is 8.51% of this thing. So if I take this $15.98 and I multiply by 0.0851 or 8.51%, I should be getting $135.99. It's somewhere in that ballpark. So this gives me the total value of my shares. This gives me the value of the dividend based on the value of my shares. Okay. So this is how we find the dividend yield, or the dividend, based on the dividend yield. Take the total value of the shares and we multiply it by that percentage that says in the dividend yield. The other thing here, and this one's a little bit weird because you got to solve for it too. So how much profit did CMCR earn per share in the past year? So they want to know how much they earned. What they're asking is, so they want to know earnings. So the thing in the ticker, coming back up here, what is the thing in the ticker that tells us earnings? And that thing is the price to earning ratio. So if I look at my P/E, price to earning ratio, it is 18.91 is what I'm grabbing from the table. I can fill in one other thing. I know what my price for the stock is. My price for the stock is $15.98. Over my earnings is equal to $18.91. If you want, you could put this thing over the number 1. You could do cross multiplication. But what you might figure out is the E is going to be this number. So there is a sort of shortcut where we could swap what's on bottom with what's out in front. But E is going to end up being 1598 divided by 18.91. So my earnings are going to be somewhere around, I believe, 85 cents per share. And if I'm earning 85 cents per share, the last question that they're asking is how much total profit did they earn in the past year. So if I earn 85 cents per share in profit, and I have 5,554 million shares, what I need to do is take the 85 cents and I'm multiplying it by the total number of shares. And if I'm multiplying these two numbers, it should give me around 720, 900,000. What is it? Billions. 4,720,900,000. Okay. And now we want to talk about bonds for a second. So bonds, there are a few things that we want to look at when we look at a bond. There's a face value or par value. That's the price you must pay the issuer of the bond to buy the bond. So that's the price you're paying for the bond. The coupon rate is a simple interest that the issuer promises to pay you. So if you get an 8% on a bond with the face value of 1,000, you're getting $80 each year. 8% of 1,000 is going to be 80. The maturity date is the date in which they promise to pay you back. The issuer promises to repay the face value of the bond. If we want to know current yield of a bond, it is the annual interest payment divided by the price of a bond. And so now we have an example 9 for a bond. The closing price of a U.S. Treasury bond with a face value of 1,000 is quoted at 107.67% or 107.67 points for a current yield of 401. Okay, and so what this thing, and sometimes they will give you a bond and they will give you points. And what they mean is the current price of the bond is 107.67% of the $1,000. And so they tell us the face value is 1,000. It's quoted at 107.67 points, and it's got a current yield of 4.1%. If you buy this bond, how much annual interest will you receive? Okay, so current yield, they're giving us the current yield is 4.1% or 0.41. And this is equal to my annual interest divided by my current price of the bond. So the current price of the bond might be something you need to figure out. And I mentioned it is 1.0767% of 1,000 or 107.67% of 1,000. Give me 1076.60. Okay, so if you set it up like this, this is the current yield is equal to the annual interest payment over the current price of the bond. You still have to solve for annual interest. So if you want to set it up like this, you can. If you want to solve it symbolically first, we're multiplying this thing over to the other side. But my annual interest is going to be equal to that 0.041 times the 1076.70 is what I'm going to end up solving this thing. And so this is giving me 44.14, somewhere in this ballpark. And that is rounding it to 2 decimal places. So if you're getting a yield of 4.1% on a $1,000 bond, and it's quoted at a different point, you'll receive around $44 per year as a payment for this thing. So we talked about stocks, bonds. There's one last sort of thing we have to talk about is the mutual funds and what their little tickers look like. So mutual funds, we have the fund name. Can't spell fund without F-U-N. So there's a fund name. This is the full name of the mutual fund. So Vanguard Long-Term Bond Index is what the full name of this guy. This ticker symbol is the VBLTX. So the net asset value is essentially, this is the share price. And it's the current price, current value in dollars of each share in the fund. The total return on the fund shares year to date is right there. We have a 1-year return, 5-year return, and 10-year returns. All right, and so one last problem to round this section out. This says we want to invest $2,000 in this fund. How many shares will we be able to buy? $2,000 in each share is 1082. How many of the things that we're going to buy? Well, we're dividing our $2,000 into 1082. So we do 2,000 divided by what? 1082. This is giving me 184.8. This is where we're going to have to use a little bit of context of what we're talking about. They're probably not going to let us buy fractional shares, although they might. But you're probably going to tell me it's about 184 shares. So I would round it to the nearest. They're not going to let you buy 185 for sure, right? Definitely got to round that down. Suppose you had invested $2,000 in this fund 5 years ago. How much would your investment be worth now? So we invested $2,000 5 years ago. Over the 5 years, if we look at the return, it grew 4.82%. I know how that works. So I want to do this. So my principal, I'm starting off with 0.0482%. And it's grown that much for 5 years. I did not do that correctly in my notes. So let's do this correctly. I want to do 1.0482, raise that to the fifth, which gives me 1.265, so in that ballpark. And then I'm going to multiply it by 2,000. I've done a few examples like this, so you should know the order of this thing, hopefully. But this should give me 2530.76. And now I'm looking at the next one. Suppose you have 2,000 and you invested it 10 years ago. How much would your investment be worth now? So the 10 years is going up by 6.19%. Same sort of problem. I have $2,000 that I'm originally investing. I'm doing 1 plus the percentage now is 0.0619, and I'm raising this now instead of 5. I'm raising it to the 10 for the 10 years. So 1.0619, I'm raising that to the 10th power, and then I'm multiplying by 2,000. This should be giving me 36, 46, 42. That's a lot of math to do for today, but we got this section done, and that is our final problem to do. So I will see y'all soon. Take care, and good luck.